You don't vote for them. You don't see their names on ballots. Yet they control your housing, your employment, your data, and sometimes even your politicians. They don't manufacture products, provide services, or create anything tangible. They move capital, and in modern America, that alone can make them more powerful than presidents. Because today, money doesn't merely influence power. It is power. Welcome to the Financial Historian, where money, power, and history collide. And nothing is ever as simple as it appears. Most people recognize the term hedge fund, but very few understand what it actually means. The name itself sounds harmless, somewhere between a legal technicality and a gardening service, but beneath it lies one of the most influential mechanisms in modern finance. At its core, a hedge fund is a private investment club for the wealthy. It pools money from rich individuals, pension funds, and corporations, and hands it to a small group of managers with a single mandate: generate maximum profit using any strategy the law allows. Unlike traditional investment funds, hedge funds operate with minimal oversight. A mutual fund, the kind ordinary people access through banks or retirement accounts, must follow strict rules. It can't take extreme risks. It must publicly disclose its holdings. It's like driving on a regulated highway. A hedge fund drives off-road at speed. It borrows heavily to magnify bets, trades complex financial instruments called derivatives, and can even profit when markets collapse. Derivatives sound intimidating, but the concept is simple. They're financial wagers on future prices. You're not buying oil or stocks themselves. You're betting on what they'll be worth later. It's like betting on next week's weather, except the bet itself can be bought, sold, and traded for real money. This world of speculation, speed, and opacity is where hedge funds thrive. The first hedge fund looked nothing like this. In 1949, Alfred Winslow, Hohn's a quiet sociologist, created it with the goal of reducing risk, not amplifying it. His strategy was straightforward: buy stocks he believed would rise and bet against those he thought would fall. But how do you profit from a falling stock? You borrow, Italiano. Here's how it works. You borrow a share worth $100 and immediately sell it. If the price later drops to $60, you buy it back, return it to the lender, and keep the $40 difference. But if the price rises to $120, you still have to buy it back, and you lose money. There's no ceiling on how high the price can go, which means losses can be unlimited. Jones used this technique to balance risk, cushioning his portfolio against market swings. It was cautious, elegant, almost academic. Over time, that restraint disappeared. By the 1980s, the United States had entered an era of financial deregulation. Regulations loosened. Inflation fell. Credit became cheap. Suddenly, anyone who could borrow could amplify their bets, and hedge funds were built for exactly that environment. They weren't banks, so they didn't need banking licenses. They weren't public companies, so disclosure requirements were minimal. They existed in a gray zone, largely invisible to regulators, yet deeply embedded in the financial system. If ordinary investors were playing chess, hedge funds were playing high-stakes poker with borrowed chips at a table the public didn't even know existed. By the 1990s, their influence had exploded. Hedge funds traded currencies, bonds, commodities, equities, even entire countries. In 1992, George Soros's quantum fund bet against the British pound. The Bank of England lost. Soros made over $1 billion in a single week. One private investor moved a national currency. That's not a market participant. That's an empire. Then came the warning shot. Long-term capital management. Founded by Nobel Prize-winning economists, LTCM relied on mathematical models so sophisticated they appeared unbreakable. The models said crises of a certain scale were statistically impossible until a Russian debt default in 1998 triggered exactly that scenario. LTCM's positions unraveled. Losses threatened global financial stability. The Federal Reserve organized a $3.6 billion private rescue to prevent systemic collapse. That moment taught hedge funds a critical lesson. If you're large enough, failure becomes negotiable. Risk was no longer fatal. It was manageable. From then on, Hedge funds didn't just trade markets, they began shaping them. In the 2000s, hedge funds grew from niched vehicles for the wealthy into trillion-dollar institutions. They hired former regulators, donated across party lines, and lobbied for rules that favored complexity. Their most powerful tools were leverage and derivatives, financial jet fuel, and explosives. With them, a relatively small fund could control billions in assets. Imagine having $1 million. You could invest it directly, or use it as collateral to borrow $9 million more, and control $10 million instead. A 10% gain becomes a 100% return. A 10% loss wipes you out. That's the hedge fund model. Speed, scale, and risk fueled by other people's money. When those bets fail, the damage spreads outward. In 2008, as the housing market collapsed, hedge fund manager John Paulson didn't just predict disaster. He built instruments that paid off when mortgages failed. He earned $20 billion while millions lost their homes. The system collapsed. Hedge funds thrived. The message was unmistakable. You could bet against the American dream and win. After the crisis, banks were heavily regulated. Hedge funds, shielded by their private status, largely escaped. They filled the vacuum. They became lenders, landlords, and lobbyists simultaneously. They bought homes at foreclosure auctions, entire neighborhoods at once, converting them into corporate rental portfolios. By the 2010s and 2020s, institutional investors owned hundreds of thousands of single-family homes in the U.S. and some cities. 1 in 5 rentals belonged to them. For tenants, that meant something fundamental changed. You weren't renting from a person anymore. You were renting from an algorithm. A spreadsheet in New York or London determined your rent, your lease terms, and whether you stayed. And if you tried to find who owned the property, you ran into shell companies across states and tax havens. This wasn't corruption. It was design. Hedge funds don't just own assets, they own structures. Legal, political, and financial systems optimized for extraction. After 2008, banks pulled back from lending. Hedge funds moved in. They began offering private credit, lending directly to companies, financing acquisitions, and even funding distressed governments. If a bank says no, a hedge fund says yes, at double the interest. This shadow banking system exploded. By 2024, private credit exceeded $2 trillion, roughly the size of Italy's economy. Banking without banks. And it doesn't stop there. Hedge funds now influence energy, food, housing, and currency markets. During the 2020 pandemic, they profited from the crash, then from the rebound weeks later. When inflation surged in 2022, they pivoted into commodities, profiting from scarcity, while households paid more for essentials. They don't just anticipate the future. They help create it. A massive hedge fund position moves markets. Prices adjust, policies respond. Even central banks take notice. Regulation has been replaced by reaction, but capital alone doesn't explain their power. Influence. Hedge funds are among the largest political donors in America. Their executives circulate between government and finance through the revolving door regulators today. Fund managers tomorrow. Laws aren't written to restrain power, but to stabilize it. And their real genius isn't rule-breaking, it's adaptability. They profit in calm markets and in chaos. Stability generates returns. Crisis generates windfalls. Disaster itself becomes an asset class. Derivatives now cover everything from interest rates to weather events. Some funds issue catastrophe bonds, investments that pay as long as disasters don't happen. If they do, investors lose money and damages get covered. You can now bet on climate catastrophe. Risk becomes revenue. Hedge funds also dominate data, satellite imagery, shipping movements, transaction records, all analyzed to predict behavior before it happens. Algorithms anticipate consumption, movement, even political shifts. This is financial surveillance. Legal, quiet, and vast. If traditional finance reads the past, hedge funds read the present as it forms. That's why some analysts call them the intelligence agencies of capitalism. Their power is structural. When hedge funds own housing, debt, food supply, and energy infrastructure, they don't need threats. Their presence alone is leverage. Regulate too tightly, and capital disappears. tax speculation, and pension funds take a hit because retirement savings, teachers, nurses, city workers are deeply invested in hedge funds. Public money feeds private power, and hedge funds don't see themselves as villains. They see themselves as realists. They argue they provide liquidity, efficiency, and discipline. In some cases, they do, but history is clear. Concentrated power accelerates until it breaks. Merchant guilds once eclipsed kings. The East India Company ruled nations. Today's empires aren't built on ships or spices, but leverage and data. Hedge funds are private sovereigns in a world where capital outruns law. They don't raise flags. They raise margins. They don't invade nations. They buy their debt. That's modern control. If hedge funds vanished tomorrow, markets would seize, credit would freeze. Governments would panic. Dependency runs that deep. So when people ask who truly governs America, the answer, I assente in Washington, it's in quiet offices, risk models, and spreadsheets deciding outcomes before breakfast. Empires once conquered land. Now they conquer liquidity. The tragedy isn't corruption. It's efficiency traded piece by piece until control no longer requires consent. History doesn't repeat, but the pattern is familiar. A new ruling class emerging not through politics, but through debt, data, and leverage. And every empire built on leverage learns the same lesson eventually. You can't short the system forever. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.